Patrick, on today's episode, I thought it was going to be a slow kind of news, but it turns out it's a lot is going on. Layoffs are ramping up. Interest rates are going crazy. Perhaps it feels like gambling. What else is going on?
Well, talk about layoffs ramping up, about purpose-built rentals. They're ramping up, and I think that's going to lead to a meltdown. And of course, we've got a population boom that is now a population bust.
Also, the banks, their risk keeps going up and up and up. And in fact, we have one chart where you're looking at a hockey stick in terms of developers crashing and the impact of Canada's condo crash. It's finally hitting the headlines. And we're going to talk about all of that and much more on this episode.
Let's rein it in. Okay, so JG, we have viewers. We're really ramping up our views. We just need some more likes, some more subscribes, and definitely some comments. We're talking about interest rates today, and we're talking about market meltdowns. Let us know, are interest rates going up or down? Fixed or variable? What are you doing? Fixed or variable? Let us know.
So, Patrick, what's going on, buddy? You don't look like you're at your normal studio right now. Are you out traveling? Are you taking some time off? What's going on?
Well, not really time off. It's always fun. You know, there's a saying, if your vocation is your vacation, you never work another day in your life. I was in Calgary this weekend. I was working with Alfonso Quadra. We did a 3-day intensive talking to real estate investors about investing in multifamily. And that's so much fun. Doesn't really feel like work. I then came from Calgary to Edmonton, where I'm going to visit one of my businesses here in Edmonton, check out a couple of my properties. I'm going to pick up my grandkids and we're going to go back to British Columbia. Yeah, got lots going on. It's been kind of a fun 4 or 5 days, but I am looking forward to going home.
I bet, yeah. You've always been like that. You like to go away, but you really like to go home as well.
I love my, what is it? The creature comforts. Yeah, I like it. And I miss my dogs. I miss Rango and Echo, Oh, my wife too. I should mention that I do miss my wife, but.
Dude, Stephanie is not going to be happy when she sees this, but that's great. I agree with you. And when you have such a beautiful property like you do, I don't blame you for wanting to go home. That's for sure. I took some time off last week as well, Patrick. I was playing uncle last week. I had my friend with their 4 kids come, 10, 11, 13, 14 years old, Adele, Mirabel, Elena, Logan. They came, we played in the pool. We went to visit. Oh man, we did so much fun stuff. And it was busy. Like we were rocking like 14 hours a day. There was no time for business last week. It was all fun. That's it.
Get to be a kid again. It's about time.
Yeah, well, that's what they call me, the big kid, right? So you know how it is. So it was fun.
Well, you are a big kid, so it was good. I'm glad you did that.
Yeah, it was fun. So, but this week, and I literally thought that we were going to have a whole lot to talk about this week. I really thought like it's the summer. It's kind of things are going to slow down. There's not going to be not as many headlines, not as much data, and things. People are going to be on vacation. But shit, that doesn't seem to be the case, Patrick.
No, it's not. It's so interesting because we've been talking about a lot of these things for a couple of years. That's the problem. I don't want to say it's a problem, but we're always looking into the future, having discussions about what's coming. And then, 2 years later, it shows up. But that's the nature of what we do. We have to look into the future that far. So a lot of this data is not surprising. I would rather be wrong than right. But at the end of the day, it is starting to unfold like we said it would unfold. And now even mainstream media's, guess what? Mainstream media's finally kicked into guess what? The condo market's coming down. Oh, really? Surprise.
They talked about that on, I saw it on, I was walking by, I think I was walking by like I forget, not a Starbucks, but I was in the mall or something. And I saw this with the kids and I saw this TV and it like, big headline, historic condo crash. And I'm like, where have you guys been? We've been talking about this for 15 months. I mean,
totally. So that's what's going on, and sadly, there's not a lot of good news economically. This weekend, we were talking to a room full of investors who are excited about what's going on because they see it the way we see it, which is in these kind of down markets, in these slump cycles, as we go into them and go through them, lots of opportunities are showing up. Now, lots of caution has to be used, and especially when it comes to financing. But now what's happening is that even CMHC is going, okay, we got to slow this train down. We got too much money at risk. They're finally picking up on it. So I want to unpack that for sure in this conversation, because I think it's one that everybody needs to be aware of so that they don't get caught unprepared for what's coming in many areas, and that is in the multifamily space.
Well, why don't we start there, Patrick? Because it's a great topic of conversation. But also, before we get into that, I don't know. You and I are both big fans of like the Rain It In, the All In podcast, I should say, right? You guys were big fans, you and I, and other friends of ours. And we got mentioned on the All In podcast this week. Did you know? Rain It In was mentioned. And I'll see if the producers go get this clip. But it was David Freeberg who was talking about reining it in. And now he was actually talking about the U.S. deficit, but
Yeah.
he said the word "rein it in," and I thought, "There's a plug for us." I mean, he's on our show.
Freeberg wouldn't be talking about real estate, that's for darn sure.
Yeah, no, he was clearly talking about reining in. Like he said, we have to rein it in. And he was talking about the U.S. deficit, but I thought, hey, I'll take a plug any way we can get it, Patrick.
So back to the rein it in plug. I mean, at the end of the day, CMHC is finally starting to rein it in. Let's talk about what we've seen coming and we've talked about. But when we look at all the developers that can no longer pencil in, make it work, make the math work when it comes to building condos, they've shut down, but they still need to pay bills. They don't want to lay off staff. So what they're doing and what they've done is entered the multifamily space, the purpose-built rental space. And so there are many of those developers going all in that space. Well, here's the thing is that CMHC is seeing the risk profile or the risk amount of mortgages that they've got, really escalate. They up their fees. They've changed the dance step, trying to slow things down a little bit. But the developers are really going hard into that space. There's the guys like you, with Invest Your Property, you guys are developing small multifamily, that's 6, 8, 12 unit kind of stuff, but they're going in way bigger in much larger projects. So we're seeing a lot of inventory right across the country. I happen to be in Edmonton. Edmonton is definitely, I don't want to say definitely, never say definitely. In my opinion, what I'm seeing in the Edmonton market, the Calgary market's already seen it, is we're going to get it into an overbuild situation in that multifamily space. We talked about this, JG. And here's the thing that investors need to know. Number one, rents will start to be far more competitive. You are going to see a lot more brand new units come online. So some of the concern there is if you've got an older, let's say a 12 unit building, and you're going to be competing against a brand new 8, 12, 20 unit building, the preference is going to probably be for tenants to want to move to the newer building. Having said that, if you are in that space where you've just done a development, bought a new units, a new multi, rents are getting softer. Like they really have capped, they're not going up. And so if you started building a year ago or a year and a half ago, and you're just coming online now, your pro forma was based on $1,500 a month or $2,000 a month rents, whatever the number is, doesn't matter. The point is there's a good chance that they're going to come down $100 or $200, not up. So these are things that we're starting to see unfold as more units come online. And by the way, JG, just to kind of play that whole scenario out, what we see in terms of units coming online actually pales in comparison to what's coming online. So these are some real concerns in terms of overbuilt, and we as investors need to pay attention, especially regionally.
Yeah, there's a couple different elements I think we should talk about. One of them is, it was 2 years ago. We were in a serious crunch. We were bringing in population like crazy. There wasn't enough rentals. Everything was renting. You remember, Patrick, we were telling investors, like, be careful. Don't go buy a crappy property here. Just because you can rent it today doesn't mean you're going to be able to sustain that rent forever. And here we are. I'm going through this situation with a property that we manage. It's not one that I own, but it was one that we manage. And as I was just telling my team this morning, they're having a hard time renting this one particular unit. And I said, tell me a little bit about the unit. We did some renovations to it, but the carpet still needs to go. It hasn't been fully, it doesn't have all new floors. It doesn't have air conditioner, right? Air conditioning. The parking is a little bit precarious. So like there's 2 or 3 little nigglies on it that are not perfect. And you know what? Tenants are saying, listen, I can be competitive. There's a great property just over there for the same price or just a little bit more. I'm going to go there. 2 years ago, people didn't have a choice. They were renting anything they can get their hands on. That's not the case anymore, Patrick. And you're absolutely right. And I think this chart, interestingly enough, I find it curious about this chart, Patrick, is when, as you see the rental orange line continue to go straight up, and then you see that condo line come straight down. It's interesting how those two things kind of happen at that exact cross intersection. And another part of this, Patrick, and I'll end on this, is the condos. Some of these condos are not selling. Guess where they're going? Into the rental pool. That is adding supply to the rental market in a big, big way.
Oh, huge. And specifically, when you look at the bigger centers, we'll use a Toronto, for example, or Calgary, even Hamilton. That condo melt up is now a condo meltdown. And it's been going on and on and on. And it's going to continue to, we'll now start to see even more headlines, because here's the fundamental about it. And I was thinking about it over the course of the weekend as we talked through, and I continue to do the research. We have to consider this. Now, we've talked about this many times, that part of the challenge that Canada's always had is the lack of productivity. Now, within the course of the lack of productivity, we didn't really see it. The general population, it seems even our government didn't frickin' see it, or the Bank of Canada. The point was this: we were driven by consumerism driven by immigration. As people come in, they set up house, they buy all this stuff. Interest rates were low at the time. Everybody's pulling the future into the present, buying stuff, doing all those things. We all were aware of all of that. But then ultimately, we had a lot of our economy being driven by real estate and by real estate investors. Well, okay, so all of that is coming to, and I want to say it came to a sudden screech. It's now the lag time is catching up. So it's like, the train, the engine hit the brakes. The last car is finally kind of all the slacks being picked up, and it's coming together, right? It's got boom. So we're going to see what happens there. But the point is this. So think about this. We have been a little bit, I think we could have talked more about the jobs, because we kind of skimmed over it. And we talked about the construction jobs and and the tradespeople that are going to be coming online. They're not going to have work, although they're working right now, some of them building the purpose-built rentals. So we think that slack has been picked up. But having said all of that, we're going to start to see a lot more of the layoffs happening. So consider construction of a bunch of towers, a bunch of condo units, so those construction workers are gone, but we can't step over the ripple effect of all the individuals. I'm talking about lawyer paralegals, just as an example. I'm talking about realtor teams. I'm talking about the fencing that goes around a job site. I'm talking about the porta potties that go to a job site.
It's equipment rental companies in general, Patrick, as another example.
Yeah, exactly. So the list of people that are affected by this and businesses that are affected by this goes far beyond just construction jobs. And, it's the restaurants, it's the, stores nearby, it's all of the things that, construction workers do, stopping to buy a coffee at their favorite Tim Hortons on their way to the job site, et cetera, et cetera. The point is that we're going to start hearing a lot more. And although we're talking about, you're going to see some numbers coming out, and these numbers are always freaking wrong, drives me crazy. And they're saying, well, no, there's, actually the jobs uptick. Well, where did they tick up? Well, they ticked up in Alberta, most of them pretty solid. Now Carney's talking finally about getting rid of some of the bureaucracy in the government. And that's not good for those workers. And I have, certainly got nothing against those workers. And so when I say it's about time, it's not without some compassion and even empathy for those that are going to get laid off. But the reality of it is we need to cut back the bloat of the government, because much of our GDP was driven by government and the jobs and the hiring. And that's not real GDP. It's not productive. This is all catching up to us. And sadly, things are just going to get worse before they get better.
Patrick, you said you're in Alberta right now, right? Like, as you shoot this, you're in Alberta. I'm actually concerned for your safety, because this is two episodes in a row that you positively comment on Carney, and you can do that in BC. That shit'll fly. But you're in Alberta right now. I'm a little concerned about someone coming up to your hotel and taking you outside. You know how it is.
Well, listen. He hasn't followed through. It's just what he's saying, and It's not that politicians lie. Maybe sometimes they stretch the truth. No, politicians lie. I don't know that he's going to do it or not. I'm watching what Carney's doing. I'm giving him some rope. I think he's going to end up hanging himself, but I'll be optimistic.
Listen, dude, I'm just impressed that you're willing to give some rope. This is great. I love it. This is fantastic.
I got
Listen,
to be. And listen,
I'm not a Carney fan. Like I wish Polyev would have got in. That was my vote. But the fact that you're willing to go there, Patrick, that just shows your savviness. It just
it's
shows
my maturity. It's my maturity. Like, I'm being wise. I'm just, listen, I'm trying to be agnostic. And to be, quite frank, I don't care what politicians in place right now, the past 10 years, that federal government has made such a mess of Canada. I don't care who you put in there. They're not going to wave their hand. It's going to be painful to get things straightened out and get things handled. And we're talking what's going on in a global macro. It's not just Canada. We're at the effect of a whole bunch of other things that are going on in the world. But ultimately, I'm going to give and be optimistic because I want Carney to win. To be honest with you, I really do want him to.
You want us to win. If he wins,
I want us to win. Yes,
of course. That's it. Now, listen, I want to talk before we move on, Patrick. So this chart that I have here on the screen, I think is quite it's quite stark, right? Like, you could just see the massive amount of and how much the MLI Select program has taken in terms of like units and how many units are coming on. And that's why you're seeing these massive spikes in the rental supply. Now, what do you do as a current real estate investors? We have a ton of real estate investors that own real estate right now. They see this, they're scared. They hear things like, oh my God, there might be we might go into like an overbuilt situation. Rents are going to crash. How do you defend yourself against this? That's a great question. That's a question the real estate investors should be asking themselves. And the answer from my perspective, Patrick, is you got to keep your unit better than everyone else's. Definitely better than average for sure. And hopefully in the top tier. And if you do that, you'll always be able to compete and you'll always be able to attract. But someone, a local real estate agent here at 20 years ago gave me great advice. He says, you attract the type of tenant that is a direct reflection of your property. Shitty property, shitty tenant. Good property, good tenant. And you as an investor, that is 100% within your control. Invest in your property, renovate it, change the floors, add some paint, update the kitchen, put some new countertops, update the fixtures. Get rid of those crappy builder grade boob lights that everybody has. Put some nice flush mounts in there. And these are not expensive things, Patrick. $500 here, $1,000 there. You just keep up on top of your property and you're going to be golden. If you let it decay, you will have a decaying tenant along with it.
So you're right 100% on all of what you said. And I want to expand on it a little bit. So of course we work and we're talking to real estate investors all of the time. This past weekend, I talked to a number of them, many who've had, they've got 100, 200, 300 doors and are very significant. And they're seeing exactly what we're seeing because that's why they hang out with us. They want those analytics. But I want to expand on what you said. So let's be really clear for investors. Number one, this is not the time to over leverage. I would be really remiss in saying, go in and get a 50-year amortization with the MLI Select if you can still and put 5% down. No, we can't do that. Right now is not the time to over leverage. You need to have liquidity. So if you're going to go and you're going to do that 5% down, 10% down, which probably the math won't work anymore. But the point is, if you did that, just make sure you have liquidity somewhere over there. But to your point, JG, is that yes, you have to have the property look good, feel good, be up to date, all of those things, bells and whistles where you can. But if you're in the markets, especially in those, I'll use Edmonton as an example. Right now, my suggestion would be to make sure you look at the tenants that you have, the good ones that you have, and you reach out. Hey, how are you doing? Get your property manager to do it, or you do it yourself. Doesn't matter. Reach out, say, how's it going? Your lease, I see it's coming due in, let's say, 3 months from now and 90 days from now. What's your thoughts? You've been such a great tenant. How about if we extend the lease and I offer you the same rent? So in other words, be proactive because you know what's coming, and what's coming is going to be downward pressure on those rents. So be proactive, engage with your tenants. If they're great tenants, maybe offer them to keep the rents at the same place, but to actually have conversation with them. So that's, certainly two things. Don't over leverage. not the time to do that. Make sure that you're reaching out to your tenants, being proactive, seeing if there's any issues that you need to look after so that they feel looked after, and then they won't want to move on. So there's a couple other bells and whistles and things to do for investors, because being proactive instead of reactive, you do not want to be chasing a downward wave, JG, because tenants are going to work you over and they're going to go shopping and you're going to lose. Be proactive.
It's a pro tip for sure, Patrick. No doubt about it. And this chart here actually shows, some downward pressure on those rents. That's what you were just talking about, Patrick. And I would corroborate this. And you know me, I often don't back up the numbers because my numbers are often different. But I'm seeing these numbers in my markets too: the Peterboroughs, the Oshawas, the Barries, the Aurelias, the Lindsays, the sort of golden horseshoe I operate in. I'm seeing this. They're down 5%. Stuff I was getting 2,000 for, 2,100 for. Now I'm getting 1950, 2,000. So they're down 50, 100, 150 bucks, depending on the quality. And you're also having to wait a little bit longer. You're not renting it within 3 days or 4 days or 6 days. You're really pushing to do it in 14 days, 21 days, 25 days. And that's part of the game, but that's why you got to be better. And the good news is, Patrick, is, as a real estate investor, people have to understand, like, this stuff, most of this is within your control. You can do things. We just gave you a list of like 12 things you can do in order to put the odds in your favor. And now it's on you as an investor to go do those things.
Exactly. And I want to point out, JG, you're managing hundreds of doors. So this isn't like 10 doors. I mean, you're managing hundreds of doors where you're seeing this. Peterborough would be, in my world, considered a tertiary market. So we know that, for example, in Toronto, rents are coming down even further. So that's what we're going to start to see in these major cities where you're seeing big development, because now here's the thing that's happening, JG. Let's talk about population growth, or the lack thereof. We have people moving out of the country. By the way, those numbers are high. I don't happen to have a stat in there, but they are. And that's not, although it's anecdotal in that I'm talking about it, there is data to support a lot of people moving, too many moving out of Canada. Of course, we continue to not have babies, so we're not having big growth. But at the end of the day, we're just not bringing in as many individuals, whether that be non-permanent residents or students, all of who are renters. So now what have we got coming? The kind of potential perfect storm of too many units, like big supply, lowering demand. So this is the time, again, to be savvy in what you do. Pay attention to your marketing. This is JG, this is a time. I don't know if you've been starting to give incentives yet, but we're starting to see some of the community saying, something, I'm putting incentives on the table right now, half a month rent, 6 months of internet, whatever they're doing, but they're being aggressive in getting people in, and they're doing that through incentives. So in some markets, that's what you have to do.
Let's just say, instead of incentives, Patrick, like, we're open to negotiation. I mean, there's, and you have to be. If you're going to be closed-minded right now, your apartment's going to sit on the market for way too long, and you're not going to end up getting the price and the rent that you want anyway. So you have to be prepared. Now, this won't last forever. We just went through years, Patrick, of like really phenomenal rents. And by the way, rents have they're down a little bit, but they're down from the absolute highs of highs here. So we have to keep it in context of where we're at in the cycle as well. And the question is this turning your real estate, your real estate deal itself upside down? Well, that really depends on how much you leverage, Patrick, which is why that's your advice, is don't over leverage. Because if you went to 95% LTV and private this and second mortgage that and so on and so forth, yeah, that extra $100 could turn you upside down. But if you did a solid deal with a 25% deposit and you're probably doing all right, and you're probably doing okay. And this is part of the real estate game. You got the upsides, you got the other sides. This is where we're at in the process.
Yeah, there's always the cycles. There are always the corrections that go in. This is something, it's interesting on the YouTube guys that are out there, and I follow a couple people, they're doom and gloom. You thought, remember we used to joke that I was doom and gloom or boomer, until I cleaned that up. I'm not doom and gloom. I'm just telling you what the data is, and that this is where the opportunities exist. So we're not here to just spell out doom and gloom. We're here to say, we'll give you some strategies to get through this. Hopefully we're doing that, which is really what's setting us apart. I'm looking at YouTube's, all they do is hammer this, the world's coming to an end, and if you bought in Calgary, you're a fool. And I'm going, what the hell's the point of even having this conversation? It's not a conversation. They're just at this side of it. mainstream media, if investors only are watching and getting their data from mainstream media, they're so far behind, they think they're ahead. This is really about being proactive and looking into the future. I do think rents are going to get softer in some markets. Here's the challenge,
Yeah,
JG.
Patrick, just to clarify, some markets, depending on your property type and depending on your location, right? That all like there's about 3 to 5 different factors that go into the rent. So if you're on the wrong side of the tracks in Edmonton, you got a crappy property, that's one thing. If you're on the right side of the tracks, in Peterborough in a brand newly built duplex, that's a completely different thing. So I just want people to understand that there are many factors that goes into determining rents and what's going to get soft. And it's always the lower end of the market that gets way softer before the top end of the market, just so everybody knows.
Yeah, 100%. And there's a couple things around this, like when you look at what's going on in Western Canada. So let's talk about Saskatchewan, Manitoba. Things are staying pretty strong there economically as our rents. We're not seeing a lot of appreciation in those markets, much smaller markets. I mean, you're talking about 2 provinces of Manitoba and Saskatchewan, where you got like 1.3 million people for the whole province. People this weekend, in the past weekend, were asking me, how do I see what's Edmonton going? Because a lot of people are liking Edmonton because economically it still seems pretty strong, but we're starting to see it soften. So, back in January, I started, when I was speaking, and I think we probably talked about it on the show, I started saying that Edmonton's starting to move into the slump cycle. And so when you ask, some people this weekend saying, Patrick, how do I see the Edmonton market? And you look at possibilities and then you look at probabilities and you examine the data. But if you want just a general, you want to know what's going to happen in Edmonton, look to Calgary. And we see what's happening in Calgary. Things are softening, prices are going down, inventory's going up, sales to listing are dropping. So we get more listings, less sales. Edmonton mirrors Calgary. This is such a hack. And could it change? Could it be different this time? I doubt it, but maybe. But the point is that in the next, let's say 12 months max, we're going to see Edmonton continue to soften. It's going to follow the same trek as Calgary as it always does, short of something economically getting a real big injection. But I don't see that happening in Edmonton.
But it's interesting, Patrick, because one of the rent slides that we just showed a while ago, you can see Calgary cooling off much faster than Edmonton. Calgary's rents have come down 6 to 8%. Edmonton's are like barely down 1%. But what you're saying, Patrick, is that's coming. So if
that's the future. Calgary is like a perfect picture of the future of where Edmonton's going to be.
If you're in Edmonton right now, like lock in those tenants, get that sucker rented, because in 4 months, 6 months, 8 months, you're going to be having probably rental pullbacks in the 6 to 8% range. So it's like it's really not that difficult. Patrick, you've been giving people this advice for well over a decade. I've been hearing you say it for well over a decade myself. And people always have the same argument to themselves, and I don't get it. This time it's going to be different. Well, okay, I guess sooner or later you might be right, but you haven't
probably not. It's probably not going to be different. So anyway, so that's what's going on there. So we've got a couple things that are happening. Number one, when we look at, let's talk about employment, JG, or lack thereof. The unemployment numbers are going to, as much as StatsCan says they're ticking up, I'm calling bullshit on it. They are not. They're going to be lagging. They're going to put in a correction, and we're going to find that unemployment is actually ticking up, although they say they're putting in corrections. It's not. Alberta is going to be the one province. Alberta, Saskatchewan are going to be the provinces that are kind of going to break that rule. I still see Alberta as being quite strong, and a lot of that has to do with pipelines. The fact that Carney's doing, he's not being, at least right now, seems to be getting behind the whole oil and gas, opening up trans pipeline. I've lost the name of all pipelines.
Yeah, the pipeline. Yeah.
Yeah. Well, we both forget it. Yeah. Anyways, it's like blank. Anyways, the point is this: Trans Mountain Pipeline. So they open it up, and things are really looking strong for Alberta. The point is I think we're going to see that continue, and as as the war escalates, and this is something that isn't in mainstream media, you don't have to dig too deep, but it's everywhere. And that is, we are literally on the cusp of a potential nuclear war. Russia is really ramping it up. Ukraine, you got NATO moving in, you've got China siding with Russia. I mean, it's getting really, really messy. The fear in the market is high. Precious metals spiked again, which is, of course, a leading indicator. We're starting to see all of those kind of risk assets start to crank up. As money's flowing into that. So there's a lot of stuff that is underlying that's going on that is really preventing people from doing a lot. Real estate aside, we're starting to see part of that is what is causing it's a self-fulfilling prophecy, because business owners and businesses, even the larger corporations, are really starting to get nervous and starting to cut back and not hire and doing all those kinds of things.
Yeah, Bitcoin's doing well, Patrick. So I was just checking there while you were talking about precious metals. So I just thought I'd check my Bitcoin. That's a precious metal,
yeah. Well, I just want to say, since we had precious metals conversations years ago, JG, prices have doubled. So, if you would have followed the old guy here.
I got my silver right here. There's 1 ounce.
There you go.
Here, hold on. I got another one right here. There's another one. Look.
Well, look at that. You are just wealthy right there.
Right
Real
there.
money.
Real money. So, and you're right, Patrick. It's not the first time that that any organization, StatsCan included, the government does, the U.S. does the same thing, where they issue stats and then they issue revisions. I was actually expecting more of that as the numbers were coming down. I was expecting more of that in the last 6 to 8 months. I didn't see as much of it, so it's curious to see where it's going to happen, Patrick. But it's going to be an interesting. I mean, to me, it feels like a very busy summer. Typically, things kind of cool off. I feel everything kind of like just, but I'm not feeling it right now. I mean, it just seems really, really busy, which means. Busy for me, but also just in general, I just see a lot of action and activity. I don't hear a lot of people talking about vacations, and they should be, because it's almost the end of July.
Well, we've talked in the past about the difference, the middle class is getting hammered, but let's just, when you start to look at the upper middle class and then upper incomes, not being so at the effect, but that bottom 60% of the cohort of incomes, and certainly the service sector, the cost of living is getting so high, and, wages are not increasing dramatically. We have a chart, that chart that we're showing wage increases. Of course, no surprise, Alberta / the Western provinces doing well. Ontario, Southern Ontario, not so well. I think that's going to continue to, kind of come through in that market, because Ontario is also way more at the effect of the tariffs than any other province. As a manufacturing sector of our world, there's a lot that Ontario is feeling the pain, a lot of businesses.
Speaking of tariffs, isn't that today or yesterday that the deal with Canada was supposed to happen? Shit,
I think they extended it to August 1st, I think, but I've lost track of what Trump is doing or not doing. There's so much saber rattling, and he goes forward and he backs up. And I mean, I guess that's the art of the deal and great negotiations. But when we look at wage growth, we're seeing that it's pretty soft relative to just how much the costs of living have gone up. And in certain sectors, I mean, you look at the cost of beef. Oh my gosh, it's like it's crazy. Somebody showed me a picture. They sent a photo of ribeyes or something, and I mean, it was like $95 for 2 steaks, and I'm going, "Are you kidding me?" Crazy. So you guys like you aren't at the effect of it. Your wallets are pretty thick. You got the money to handle it, so it's just like annoying. But for the rest of the world.
No, for sure. Yeah, it absolutely does make a difference, Patrick, and people are feeling it. There's no doubt about that. And it's I know I have these conversations all the time with renters and friends of mine, and it is. I mean, and this is why you and I have talked about this, and I feel like a broken record, because I say the same thing to them when we're having a glass of wine in my house. It's like, this is why you have to invest in assets. This is why you have to invest in hard assets, because it will keep you ahead of that inflation. If not, you're going to be behind forever. I mean, people are just feeling that. I mean, yes, the inflation went up more than usual in the past couple of years, for sure. It went through a spike, but it's still, Patrick, that the bottom line is still the same thing, which is inflation is always eating away your money. And if you don't invest in hard assets, you're going to feel that pain for the rest of your life. That's bottom line.
You're so right, JG. And it's interesting is that it doesn't. We seem to be kind of the optimists in it all, although we're being very cautionary. We're not saying invest in real estate to get rich, although you will create future wealth. I'm saying invest in real estate because you need to get your capital to work, given the rate of inflation that we're going to get hit. If you think things are expensive now, just wait a couple of years. So the point of it is that that money that you might have, that cash that you got sitting in a GIC at 3% or whatever the numbers are these days, I have no idea, 4%. But the point is that you are losing buying power every day that your money sits in cash. Get it into hard assets, stores of value, real estate being our choice, one of our choices. But the point of it is that it's not as silver, gold, Bitcoin. It's not about throwing money up against the real estate walls. This is where you get to be strategic. You get to find deals. You get to negotiate better. You get to really build a powerful real estate portfolio. So we're kind of in the middle in that, saying, yes, real estate still works, different, motivation than, let's say, through the boom cycle that everybody was caught up in. The point of it is that there's many out there saying, run for the hills because the world's coming to an end, or the real estate world's coming to an end. It's going to, go whatever the stories are, it's going to blow up. Yeah, it's melting down, but this is where the opportunities exist. So be cautious, but there's still opportunities.
Now, last topic of conversation, Patrick, that discusses these. This I thought was a pretty fascinating chart about Canadian bank loans for real estate development. And look at this hockey stick. I mean, I can't even call this a hockey stick. This is like just straight vertical.
Well, that goes back to the other vertical, which is purpose-built rentals. That's where developers are putting their money because they don't want to lay off staff. They've still got bills to pay, so they got to drive revenue, and they can't make condo market deals pencil. Nobody's buying pre-construction. We've got that start on pre-construction. Toronto pre-construction sales are down, 90%? I mean, we're at historic lows in terms of pre-construction sales right across the country. Toronto happens to be one of those extremes. Ottawa being a government town, it's kind of it's pretty soft there. There's lots of employment, government workers, etc. It's a different market. Ottawa continues just to be steady Eddie. Ottawa seems to be doing quite well in that space, given the employment that's there. So when we look at this, by the way, JG, is that lenders are getting way stickier. You know this, and you talk to anybody who's trying to get financing. Man, it's painful. And it's shutting some investors down who aren't really committed, who want to, but they're going, I'm not working that hard. Like, it's crazy. Somebody's talking to me about a year to get a 14 unit refinanced or something.
I mean, the most positive person in the world. I've been called that by one of my clients who's a common friend of yours and I's, Patrick. He said, I agree with Patrick. I think you have the most rosy sunglasses I've ever seen. So, but even I, Patrick, I'm like, holy shit, I think I'm going to stop buying real estate just for a minute because it's getting so difficult to do the deal on the financing side. It's ridiculous.
It is crazy. But this is what is some of the risk that's out there. We are in, globally, it's a debt crisis. Let's face it. We're so at risk. Canada debt is off the charts. We're in the top 3 or 4 of all countries in terms of debt cycles and debt risk. Now, what's happening, we're seeing bond yields go up. I think they're over 3% today, which means fixed rates. I did get a quote on a fixed rate at 3.99. I think I'm going to lock in. I don't know. I have to decide.
You got 3.99?
Yeah. So I think I'm locking in for 5 years. I look at here's the risk. You got to look at
crazy not to. I'll tell you right now. If that was me, I'd be taking it.
Yeah. Oh, well, totally. I am. Possibilities, probabilities, right? Do I think rates are going to come down? Maybe they'll come down a quarter point, maybe, but the possibility of them going far higher.
Exactly.
Yeah. Well, so risk mitigation says I'm locking in for 5 years.
Not to mention, listen, this isn't a primary, Patrick. This is a rental.
Yeah, rental. Well, one primary and one rental.
So I mean, that's a phenomenal rate because and people still and it's fun. I don't know how long it's gonna take for people to get out of this mindset, but people are still in their mind like, oh, maybe like wow, 3.99, that's far from the 1.7 I had a couple years ago. Like you're that's over. That's done. You, don't compare it to where it was a couple years ago. Compare it to where it was in 2015, 2017, 2018. And the odds are you were probably at 3.99, 4.25, 4.5. That's probably where you were.
The only difference, of course, is that prices are far higher now than they were back then. So if you're going into the market and you've only been in the market for 3 or 4 years,
So are the
yeah,
rents. So
yeah,
are the as a real estate investor, so are the rents. I used to
yeah,
rent stuff in 2015, a 3 bedroom for 1,500. Now I rent a 3 bedroom for 2,400.
yeah, 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 yeah.
So
So it's an interesting time to say the very least. And I have to keep encouraging people, something as much as you may not like Twitter, there's lots of good guys to follow on Twitter that are giving data, giving stats in a realistic kind of way. And so, avoid mainstream media. The information's either late or wrong. That's always kind of my guidance in that. Do your research. GDP growth, let's just touch on it really quickly. Soft as hell and getting softer. I mean, there's nothing, when we look at what's going on in Ontario versus Western Canada, I think that arguably these numbers are elevated. This is a stats from StatsCan and TD Economics, but at the end of the day, we have to understand that GDP number is short of Western provinces.
this is a forecast. This isn't
Yeah,
the actual numbers. These are forecasts for the rest of 2025.
yeah, yeah. Alberta, yes, exactly. So Alberta will continue to do well, as will Saskatchewan, Manitoba. Again, Ontario is just going to be, it's just not good for Ontario. And sadly, that's the biggest part of our country, or most populated part of our country. So that's where most of the pain will be felt for sure. I don't see that going away anytime soon. And by the time Carney gets a lot of things sorted, it's going to be a lag. And so it's hard to be optimistic about the job and GDP growth going forward in those provinces.
Look at Newfoundland. Newfoundland's killing it, 2.1%. Patrick, I recommend we all move to Newfoundland. That's what I'm thinking.
Yeah, it'll all go until the next tariff gets dropped, and then that'll change that whole thing.
Oh, that's great. That's great. Well, Patrick, it's it is the middle of the summer now. I'll call it the middle of the summer. We have it's been a really hot summer over here in Ontario. My gosh, we've been just cooking. It's been like 6 weeks of 35, 40-degree weather every single day. No rain. I've had no rain. I collect my roof water. Patrick, I haven't had a solid rain. I've had one solid rain in 6 weeks.
We golfed yesterday, and it rained and blew for 15 holes. It was miserable. Our hands were so cold we could barely hold the club. We still had a good time, and it was fun. It cleaned up. And of course, you know what happens? 15th hole, the weather kind of gets better. The wind dies down. It warms up. There's no rain, and we get a couple of good shots, and then we're all back to being, golf superstars. So there you go.
Until the next golf round, right? So, hey,
Exactly.
speaking of that, are you? I don't know if you're firmed up yet, but the Vistcher Golf Tournament is coming up September. I think September 8th. That first kind of Saturday.
Yeah, guess what, dude? You're missing an opportunity too. I'm not going to make your golf tournament because I'm in Edmonton again. We've got Recon, the Real Estate Investor Conference, which you were at last year. It's that weekend with Calvin and Alfonso and Wayne Hillier and a whole bunch of great speakers. And I'm going to be both speaking and probably emceeing that, doing some MC duties at that event. So looking forward to doing that. And sadly, I'm going to miss the Vistcher Golf Tournament unless you want to move that to the following weekend, JG. Then
It's all booked up, buddy. I apologize. I can't move it, but it's going to be fun. That Saturday, I think it's September 6th. I just had a look. So, yeah, excited about that. And it's always a great time. So, Patrick, I'm going to be very curious. I was hoping it would happen on this episode, but the next episode, hopefully this Canada free trade deal is done. Or well, I call it free trade deal. Just call it a trade deal. I don't think there's anything free about it anymore. So it's a trade deal. And hopefully we'll have that to talk about on the next episode.
we'll have lots to talk about. There's always lots to talk about, JG. Let's face it.
Awesome. Thank you for a fantastic episode. Until next time.
Thanks, JG. If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.